The last time I talked to you about the Rise Fund was back at the World Economic Forum in Davos, Switzerland. And at the time, you'd made 9 investments and you'd committed about a quarter of your capital. Where do you stand today?
So we've now made 16 investments and we're about halfway through the fund. So about half the fund's been invested.
In the space of less than a year?
That's right.
Pretty quick.
Yep. No, things are going very well. And more importantly than the statistic of the amount of investing we've done, the impact that we committed to is going extraordinarily well. We're actually ahead of plan on all dimensions, and fundamental performance of the businesses which tie to that impact are also doing well.
So I wanted to talk about impact. Candidly, I was saving it for later in my conversation, but since you brought it up, let's get into this.
Yep.
Because it is a thorny subject that many people wrestle with, both conceptually and then practically.
Yep.
How do you measure impact?
So we spent about a year and a half before launching the fund working with Bridgespan and about 80 different organizations that have done a lot of great work over the years, trying to figure out how you can actually credibly measure, underwrite, measure, report, and ultimately audit impact. And before raising the fund, we got to a place where we were confident we could do it. The good news is we've now done it. We actually published our first impact report, which details the specific social and environmental impact generated by each of our companies. It was actually audited by KPMG, and that report came out about 3 weeks ago. The simple exercise is we connect the dots between the output of the business, both positive and negative externalities, the output of the business. We underwrite the amount of that output that we're generating and translate that into a monetary measure of the impact that our dollars invested are generating.
But isn't it somewhat subjective in the sense that you're deciding where you're looking for that impact? And perhaps at the same time, there's some confirmation bias there in the sense that perhaps some of the maybe negative impacts that an investment or a business may be having aren't as adequately measured.
So the key to this whole effort of the Rise Fund is to come up with a credible way for investors, both institutional investors, but direct investors, governments, philanthropies, to measure ultimately the positive and negative effects of their investments. So we're very rigorous about it. I'd say we're making good progress. I can't represent to you that we've absolutely nailed it across all sectors, but in the sectors where we've been investing, we have a measure that's good enough that it passes muster with an auditor, and good enough that third-party data validates what we're actually generating.
Can we talk about one of them? Can you give me an example?
Yeah, I'll give you two examples that are quite different. One is a company called Dodla Dairy that is the 4th largest dairy business in India. It's an interesting model because they collect milk, 1 million liters of milk twice a day from 280,000 small stakeholder farmers. And this is the 70% of the world that are the poor, are small stakeholder farmers. We test the milk, we pay them with long-term contracts on the spot for their milk, and over the course of improving their productivity and providing reliable offtake, we've generated a 50% uplift in the household income of those small stakeholder farmers. So by improving the productivity of the small stakeholder farmer, we create collinear improvement in the business. So there's no conflict between the two whatsoever.
Right, I don't see a whole lot of downside there.
No.
But when we last talked, you said, hey, it wouldn't have been great had we raised the Rise Fund before TPG Growth invested in Uber. We could have invested there. Now, people may agree with you that Uber has had some benefits on an economic level, on an individual level, but it has also been, I hesitate to use the word because it's so overused, but let's use it anyway, disruptive.
Yep.
Right? It's just, for example, destroying the black car industry here in New York City. So there's positive and negative at the same time. And it's hard to know where they net out.
That's right, Eric. There's always positive and negative. What you can say definitively is every investment has an impact, positive, neutral, or negative. The exercise today is to figure out how do you measure it on a comprehensive, sophisticated basis. How do you measure the effect of an Uber? We all deserve to know what the impact of these companies are that we are investing our precious capital into as a society. And our belief is, with all the work we're doing and with the help of a lot of other players in the impact industry, that we can come up with a way of measuring it that is a big advance from where it's been, such that we can bring that lens to bear, the net impact lens to bear when we're making investments.
You talk about other players in the impact industry. How competitive is it getting?
I wouldn't say it's competitive at all. I mean, when you look at the overall private equity landscape, for example, it's enormous.
But not every private equity investment is suitable for a social impact fund. In fact, most aren't.
Well, the total dollars invested last year in impact was $6 billion. So it's a very small industry, very nascent. It is our hope that it will become very competitive. It is our commitment that the measurement standard that we're developing with Rise Labs will be available for others to use. We made that commitment to our LPs, the big institutional investors that for the first time came into the impact world.
You want it to be a benchmark.
We want it to be a benchmark that allows others to participate in this effort. It's going to take. There is a $40 trillion problem, investment challenge that we need to address, labeled the UN Sustainable Development Goals. There isn't enough philanthropy in the world. There certainly aren't enough government dollars to get there. So we need to orient business solutions, commerce solutions, scalable enterprise to address these big social issues. It's going to require this kind of investing at scale.
Bill, people don't realize that social impact investing is just investing, which is to say you're buying whole companies or stakes in companies, just like you would if you were in private equity or TPG Growth.
That's right.
You just have a double bottom line.
That's right.
You want to generate a financial return, and you want to generate a socially meaningful, beneficial return.
And to your point, it's critical that we bring the same drive and verve and energy that we've brought to all the investing we've done over the last 25 years as a firm to these companies. They're no different. An impact company doesn't have a different set of rules apply. It requires the same great leadership teams and the same access to capital markets and all the other business building tools that we bring to bear to help these entrepreneurs scale their business.
So that helps to explain why it makes sense for a TPG to be doing this.
Right.
But the question it raises for me, and possibly raises for others, is does the fact that you have a secondary objective mean that you're prepared to pay more for a socially impactful business than, let's say, any other private equity or growth fund would?
So
because they might find them attractive strictly for financial purposes, but you've got another reason to want it.
Yeah, I mean, ironically, because of the interest entrepreneurs have had in being part of the Rise Fund and joining with our founders board and being part of a purpose-driven effort like this, where it's precisely the opposite is taking place. We're finding that we're quite differentiated. We're getting a lot of proprietary opportunities. We're paying less for investments because these entrepreneurs want to be part of the Rise Fund movement, if you will. So it's precisely the opposite.
You don't feel you're competing at all with traditional private equity or
for sure. It's almost, it would be an inconceivable scenario that we would find a great company where there weren't other capital sources interested in that company. What I'm saying is what's interesting is that we're finding we get a proprietary look as a result of what the Rise Fund stands for, our commitment to impact, the fact that we can actually characterize the impact the entrepreneur's delivering, present it to the world. They want to be with the kind of people that are part of the founders board of the Rise Fund, Bono, Jeff Skoll, Laureen Jobs, Reid Hoffman, Benioff, Lynn Benioff, et cetera, to support their journey, which they do. So we're able to get, ironically, a lower priced entry in many cases because it's considered differentiated, and it is in the market.
So as we established at the outset, you have committed half, roughly speaking, of the $2.1 billion that you raised. If you continue at the same pace, you'll be fully committed in less than 2 years. What then? Are you already, and is this fund, let me put it this way, could this fund be opened? Can you raise more into this vehicle? Or are you already thinking about Rise 2?
No, we cannot raise more capital into the existing Rise Fund. We're busily building these businesses and investing. It's not, we haven't had to frankly worry much about raising the next fund. What we find in all of our funds is when you deliver on the promise and you're performing, raising capital is not the challenge. It's doing the core job that's always the challenge. So as long as we keep delivering the returns and exceeding the impact that we committed to, which we are, and delivering a measurement methodology that's truly credible, raising the capital is not the problem. The problem is to do what we do for a living.
Speaking of which, what are the most salient lessons you've learned thus far, both on the positive and the negative, quickly?
I've been amazed at how broad it goes back to one of the questions you asked me. I'm amazed at how broad the impact opportunity is. It's everywhere. As soon as you can measure it, you see it in the derivative and second derivative, which is quite extraordinary.